Welcome back to The Explainer. I am so thrilled to have you here today because we're tackling one of the absolute most fascinating illusions in our modern world. In our last deep dive, we discovered a pretty profound truth. Money isn't just paper or metal, right? It's an entire system built completely on trust. But, that discovery left a massive, glaring mystery right on our doorstep. We know what money is now, but we really need to figure out where it comes from. So today, we are going inside the invisible money machine.
So, who creates your money? Honestly, if I stopped you on the street and asked you this, you'd probably give me the exact same answer everyone else does. The Reserve Bank of India, of course. And it makes sense. After all, they manage the whole monetary system, they influence interest rates, and they literally print the physical currency notes. It's common sense, right? The RBI creates the money. Well, hold on to that thought because we are about to completely break that baseline assumption.
Okay, let's dive into this. To actually solve this mystery, we first need to draw a hard line between two very different things: physical cash and digital deposits. Yes, absolutely. The RBI prints physical currency, the 10, 50, and 500 rupee notes sitting in your wallet right now. And the government of India issues the 1 rupee note. But those physical notes, they're just a tiny, tiny fraction of the economy. The vast majority of the money you interact with every single day isn't physical at all. It's entirely digital, and it's created by commercial banks, existing simply as numbers on a screen.
Section 1. The illusion of cash and the reality of deposits. Think about your own life for just a second. When was the last time you paid for literally everything in a month using stacks of physical cash? Probably never. Your salary gets directly deposited into your bank account. You pay your rent through a digital bank transfer. You buy groceries using UPI. Your mutual fund units, your stock portfolio, it is all entirely digital. The modern economy just doesn't run on physical cash anymore. It runs on bank deposits. And the way those deposits work is, well, it's a bit of a mind bender. By definition, a bank liability is money that a bank owes to its depositors. It's an obligation to pay. Imagine you walk into a branch and deposit 1 lakh rupees. To you, that money is yours, right? It's your asset. But from the bank's perspective, that deposit is a liability. The bank literally owes you that money back. They're sitting at the center of this massive, tangled web of financial claims. Deposits from millions of everyday customers, loans given out to businesses, mortgages held by families.
To really wrap our heads around how this web actually creates money, let's look at a concrete, real-world scenario: 50 lakh rupees. Imagine you want to buy a house and you need exactly this amount. Now, you obviously don't have 50 lakhs just sitting in your checking account, so you apply for a home loan. The bank checks your income, your credit history, your collateral, they assess your risk, and finally, you get approved. Boom! Suddenly your banking app shows your balance has increased by 50 lakh rupees. But wait, did the bank manager go down into some heavily guarded vault, pack 50 lakhs in physical cash into a briefcase and hand it to you? Absolutely not.
And this brilliantly illustrates the magic trick. Because when the commercial bank approved your loan, they didn't move existing money around. They pulled off an incredible accounting trick. They simultaneously created a new asset and a new liability, literally out of thin air. Notice the asset side here, the 50 lakh loan. It's an asset because you, the borrower, owe the bank that money. But the liability is the new 50 lakh deposit now sitting in your account because the bank owes you that balance. They just typed some numbers into a computer and poof, new digital money was born.
So here is the absolutely crucial takeaway. Most modern money is created electronically through the banking system. When we hear the phrase money is created, our brains automatically picture this massive industrial printing press running day and night, stamping out paper notes. But that is the old paradigm. In reality, commercial bank lending is the primary engine that expands the amount of deposit money in the economy. Zero printing press required.
And this single act of lending builds into this fascinating continuous loop. Just follow these steps with me. Step 1. The bank lends money to a business so they can build a new factory. Step 2. That business spends that brand new digital money to buy materials and hire a workforce. Step 3. A worker earns that money as their monthly salary. Step 4. The worker takes that salary and deposits it right back into a bank. Do you see what just happened there? One person's borrowing becomes another person's spending, which becomes yet another person's income. As this credit flows, the entire banking system expands and the total money supply actually grows.
But, there's a flip side to this coin. Think about your monthly EMI payment, the one split between principal and interest. We just established that taking out a loan creates money. Well, repaying a loan literally makes that money disappear. No joke.
Every single month you pay down the principal on your home loan, the bank's outstanding loan asset shrinks, and the corresponding deposit money in the broader system shrinks right along with it. Money creation is absolutely not a one-way street. The financial system is like a living, breathing entity that constantly expands when loans are made and contracts when loans are repaid.
Section 2. When credit goes wrong.
Now, this system of endless expansion and contraction, it's fantastic when times are good. Credit finances businesses, it builds our infrastructure, it funds life-changing innovation. But we have to remember, every single loan creates debt, and debt is a strict, unforgiving responsibility. Eventually, someone, somewhere, has to pay it back. Ultimately, a loan is only valuable if the borrower can actually repay it. Imagine a bank lends 100 crores to a business, but then disaster strikes, sales collapse, costs skyrocket, and cash flow just dries up. The company defaults. Suddenly, that shiny digital asset on the bank's balance sheet is entirely worthless. If enough businesses start struggling at the same time, banks accumulate bad loans. They get scared. They lock up and stop lending. Credit grinds to a halt, businesses stop investing, consumers borrow way less, and the economic cycle dangerously throws itself into reverse. It is an incredibly powerful force that can amplify terrible economic downturns.
Section 3. The role of the RBI. Okay, so if commercial banks are the ones out there creating deposit money through all this lending, who keeps them in check? Who makes sure this whole speeding machine doesn't just fly right off a cliff? Well, that is the true function of the Reserve Bank of India. They don't just sit in a room in Mumbai counting how many 500 rupee notes are floating around. They act as the ultimate regulator and architect of the financial environment, and they use this massive interest rate lever to do it. Notice how tighter conditions mean higher rates. When that happens, funding costs for banks shoot up, home loans become super expensive, and businesses put their expansion plans on hold. Credit slows down. Conversely, when the RBI wants easier conditions to stimulate the economy, they lower rates, making borrowing highly attractive again. This one central decision ripples through the entire system, directly impacting loan rates, bond yields, and even what happens in the stock market.
But keep this in mind. Even central banks don't have unlimited power. Because while the RBI can make borrowing cheaper or more expensive, they can't force you to actually take out a loan. They can't force a commercial bank to lend money to a super risky business. The true beating engine of money creation depends entirely on everyday people's willingness to borrow and the commercial bank's willingness to lend. Furthermore, it's not like commercial banks can just run wild and create infinite money whenever they feel like it. The entire system is bound by some incredibly strict guardrails. Capital and liquidity requirements, intense regulation and risk management from the top down, the actual credit quality of the borrowers themselves, and real-world borrower demand. A bank isn't just going to hand over cash to someone who clearly can't repay it, because when those loans fail, the bank takes a massive hit. Finding that exact right balance, not too little credit, which literally starves the economy, but not too much, which creates these devastating financial bubbles, that is pretty much the single greatest challenge in modern finance.
Section 4. The foundation of trust.
So we have covered a ton of complex mechanics today, tracing the path of money from the central bank straight through the commercial banking system into businesses and finally landing in your digital account. We've seen how lending expands our economy and how repayment contracts it. So let's step back and summarize the core takeaways here. The actual ingredients of modern money are a dynamic combination of physical currency, digital bank deposits, credit, and debt. But the final ingredient on this list, it's without a doubt the most important one: trust. It is the invisible, incredibly fragile pillar holding up this entire giant money machine. Because money isn't just printed, it's lent, it's spent, and it's repaid based entirely on the collective confidence that the system actually works.
Which really leaves us with this final kind of chilling question. What happens when everyone wants their money at once? Imagine waking up tomorrow to the breaking news that your bank is suddenly unsafe. You and millions of others rush in a panic to withdraw everything immediately. The reality? The bank simply does not have enough physical cash in the vault for a mass withdrawal. The system isn't designed for it. And when that underlying confidence shatters, the entire invisible machine grinds to a terrifying halt. Just think about that the next time you look at the balance on your banking app. We'll explore exactly what happens on the day everyone wants their money in our next explainer.